I've always had something missing, because technical analysis was always answering the question when, but I did not have the question why. My trades are always on four parts: setup, signal, stop, and size. So seasonals is the setup. It's not a signal. So which means I may have a bullish seasonal period, for example, as I mentioned, soybeans, but I have to confirm it with price itself.
I'm right in saying you use technicals on the daily for your trigger?
Yeah, so when I go into the daily chart, I have what I call the core four of technical analysis, the four most important aspects of price, which is.
Welcome back to the Unpacking the Markets podcast. Now, before we kick off, can I please ask you to subscribe to this channel so that we can continue to grow and help traders worldwide? Let's get into it. I was semi-surprised when I saw, an award-winning technical analyst start his trader development program with the S, that is the self. So can you talk a little bit about why you start trader development with the self component?
Yeah, sure. Well, that's a very good question. Um, all right. What is smart? Just a brief note what smart trader systems is before we bring the context before the content. Well, smart trader systems, basically smart stands for five the acronym stands for the 5 stages of trader development, and systems because I think as you can have systems for trading, you can also have systems for learning. So going back to your question, what the S of the smart means, the first is self-awareness, and there are 4 steps to self-awareness, and I think it's the first step before someone starts to learn how to trade, by evaluating the 4 steps that one has to see before they start trading, and to see actually maybe they shouldn't be trading, maybe this is not something for them. So S stands for self, like I mentioned, for self-awareness, and there are 4 steps to it. First you see your goals. So what do you want to do? Do you want to be like a professional? Do you want to do it full time? Do you want to do it part time? Do you want to do it for like fun? Because that's also acceptable, as long as you're willing to bet fun money, fun time with it. I mean, understand that there is like a, for some people, not for me, but there's some people, there may be um entertainment value to this. So as long as you say, okay, I'll bet like 2 grand per year instead of collecting stamps or betting on horses, or do you want to do it part time or full time? So basically that's your goal, and then you've got to see the realities of it. And the realities are, there are 4 aspects to the realities. Basically you have to have 4 types of capital: financial capital, how much money you need, because you need different money if you want to be doing it full time, different amounts of money if you want to be doing it part time. You also have to see your time capital, because time is money, as they say, how much you have to devote. Again, depending on your goals, that will be different. You also have to see your educational capital, how much you need to learn
Hmm.
and in what way. And the fourth is your emotional capital. And that emotional capital is a self-reflection on your own psyche, but also on the environment that will be supporting you. Because although this supposedly is a sport for one person, actually it shouldn't be. You should be having, first of all, the support of your family first and foremost. There is nothing worse than trying to achieve a goal without your spouse's help and support and approval. So even if you win, you should definitely ask your wife, assuming that it's a man, because don't want to be sexist, but 80% or 90% of traders are usually men. That's why I'm saying this. Or again, if it's a woman, ask your husband. And also so emotional support, not just from your family, but also from a mentor, someone who will guide you. not just from the technical aspects of it, but also emotionally, and also create a peer network. Because this can get a bit lonely, so you need to have like-minded people to exchange views, hold your hand through the lows,
Mm.
try to keep your head down a bit when you're high, and so on and so forth. So these are the basic 4 steps. I mean, we can elaborate in each one of this, but these are the aspects of that you must evaluate. Also, you must see the obstacles. That's because between where you are and where you want to go, like these 5 stages of trade development, you also want to see the obstacles, which are basically usually mindset related as far as I'm concerned, and also see your will, how much you want this. I mean,
Mm.
saying that you like it is one thing, but how evaluating how much you really want it, and you can see that also by the urgency of your decision to start. So basically, that's a good discussion to have with someone, not in terms of someone approving you if you should be doing it, but providing you food for thought, and so asking you the question so you can do an internal dialogue and come up with the questions yourself and say, okay, I really want to do this. I have a clear idea of what it is, or maybe this is not for me. So that's what the S stands for: self-awareness. So making a very conscious decision, not emotional, but really seeing what you need in order to see if you should start trading or not.
Mm. Yeah, I love that because, I mean, first of all, it's something I definitely didn't do when I started. And I wonder, is it because I didn't want to know the answer to some questions, some of those questions, because they're hard questions. Like, it's a very mature approach to trading, getting really thinking through what does this mean for me on my day to day? Can I afford it, as you said, mentally, um, financially, in terms of your education, etc. Right? Was it something you went through when you started?
No, unfortunately, I didn't. First of all, the first reason is because at a very young age, this is all I wanted to do. Um, I was actually inspired by my father, who worked for a Bank of America in Greece. So he went for a trip to Britain, to London. Actually, it was a business training. So he saw a dealing room in the Bank of America in London, and he said he came back very excited. And he said, "Son, you should be working in a bank dealing room."
Mm.
So, as a 15-year-old who wanted to impress the father, said, "Yeah, sure, Dad," although I had no clue what a dealing room was. So, in any case, no, I found myself attracted to economics. I went to City University, and I think this is where I was like, I did a banking and finance degree. So this is when I started getting more intensely the desire. I mean, I knew I wanted to be in finance. I wanted to be in capital markets, probably around my last year. And during my third year, this is when it really clicked for me. Uh, Fate, God, no, showed me this path which I never went to. I actually followed afterwards. We had a professor called Roy Batchelor, who retired last year actually from City University, and that was the first year he taught technical analysis. Roy was an ex floor trader, so he used technical analysis, so he knew the value. But at that time, when I say that time, that was in 1996, um, technical analysis was a bit of a heresy in the academic community. So that was like almost 30 years back. But he wanted to teach it to the students. So he decided to kind of like disguise it. So he put some econometrics at the front, some econometrics at the back, technical analysis in between, and he called it a forecasting course. So that's when I first learned about technical analysis. I think that was probably the age of 21, 22. And I fell in love with it. And I said, no, this is all I want to do. And afterwards, I never regretted doing it. So I didn't go through the new CIF evaluation process. I just said, I really want to do this. And later on, I found out I was too stupid to do anything else. So that's how it started for me. But yeah, if I don't think that's the best choice. I mean, In terms of, if someone wanted to do, I think it would be best if they did this as self evaluation, although I didn't have the chance. So um, this framework I have created is kind of like, um, if I had the chance to go back, like say 30 years, and condense everything I know now,
Mm.
this is what I would teach myself 30 years back, and save me a lot of heartache and trouble.
Yeah. Yeah, and money. Yeah.
Oh
You know,
yeah,
is it, yeah,
money,
because, well, yeah,
time.
it's, I mean, how many people, and I say how many people, anytime I pose a kind of rhetorical, it's me talking to myself when I started, just dive into a black box system. They don't do any conversation with themselves. They don't know how it's going to work. They think they're going to make 10% a day, and then they just find the trend following system and then lose their money. And then gradually 2 years later, they start to ask maybe more
You,
mature questions
it,
like,
it is a business, and one literally needs to do a business plan. So if you condense, the first stage of the trader development, it's like literally doing a business plan. I mean, just
"Hmm,
taking pen and paper and say, what do I have to in front of me? Do I have the money for it? Or if you don't have the money for it, most likely you won't. How do I find it? What other avenues of funding are there? Because there are likely funding. I mean, they've always been prop firms, and when back in the day, it wasn't like they are today, which is basically, it's unfortunately, prop firms now, they've got better. At least in my mind, a bit of a bad reputation. They're more like
hmm,
renting demos rather than
that's
actually
right.
being. I mean, you had to be working on the floor and so on and so forth. So there are avenues to find capital, if you will, but you have to make compromises, and you have to make the right choices and say, okay, be very um, planned about how you will start your career.
Hmm. Yeah, and that end goal, as you said it, at the start, do you want to do this full time, and do you know what it means to do it full time? Because like a lot of people, I kind of thought I would like to do it full time. And the thought is still in my mind, but I'm under no illusions as to how difficult it is. As you said as well, how it can be lonely, and it's all fun and games when you're making money, but when you're down 3% on non-farm payrolls, it's not so fun anymore, right?
No, it's not, and you need the support, both the from the technical point of view, from the emotional point of view, not to feel lonely. I mean, there are many aspects to it. I mean, unfortunately, sometimes people um, see this just, oh, I can learn a few technical analysis patterns and then I'm off to the races. But it's a
Mhm.
lot more difficult. There is a huge psychological aspect to this. Even if someone is fully systematic, there's still a psychological aspect to, because the markets will challenge you and will come to the point, okay, will I, unplug the system, or shall I start
Mm.
tinkering with it, or shall I change the parameters? I mean, it does get to you, so you have to have the discipline. Although as a fully systematic trader, you don't have the execution challenges that a discretionary trader may have, but you still have to go through the drawdowns, which is the
Mhm.
same whether you do it systematic or discretionary.
Yeah. Yeah, when I spoke to Rob, I know he's, as in Rob Carver, he's fully systematic, and I asked him something similar, and he was saying, kind of course, you still have the temptation, but you even build systems into your system to try and not tinker with it. Reports on how things are going, and if they're within standard deviations, and if they make sense, and things that should keep you at bay. But it was around the time that we had a lot of French political risk when I spoke to Rob. So French bond yields were rocketing, euro dollar was pushing lower, and I was kind of saying, oh, do you ever get the urge to open up your brokerage account and get short euro dollar on the political risk? It's all this kind of stuff, and he's kind of like, or he basically said no. So I think over time you also maybe build a muscle of not getting involved in your system.
Yeah, and I think it comes to experience, because sometimes I get asked the question, how does one become more disciplined or more emotional? And I think
Mhm.
there are three ways to get more disciplined. First of all, is to have a, although it sounds like a cliche, to have a plan. a very definite rules-based plan. Like if X happens, I will do Y. If Z happens, I will do this. So you have to be really, really rules-based. The second thing is repetition, and I'm talking from a discretionary or semi-systematic point of view, because that's the world. I mean, I'm halfway, you know, between discretionary and systematic.
Mhm.
So repetition that gives you gradual desensitivization, which is the equivalent of like watching a thriller um, several times. I mean, the first time you see it, you get a bit emotional about it, and so someone comes with a knife, you see it, and you get scared. But if you see the same scene 10 or 15 times, then you no longer get shocked by it. So it's the same thing with markets, and also having a small position size. Um, because that really heightens, I mean, a big position sizing heightens your emotions and the fluctuations. So
Mm.
keeping your position size low and having a diversified portfolio, that also helps a lot with the emotional burden of market fluctuations. Because, for example, if you just say bet a small percentage on any trade and you have your stops in, then you probably need to die the death of 1,000 cats to start affecting you, because each cut individually will not be that much.
Mm. Yeah, that's super advice. Um, and it reminds me of someone I spoke to when they said from their journaling process they had realized a smaller risk let them be more comfortable letting winners run, and so they made more money. Whereas when they put bigger risk on, they tended to cut the losers quickly. And it's just a super point that, as you said, the emotions just amplify, especially if you go above what you should be risking, and then
Absolutely.
yeah,
So bet small, and try to have a hold your positions more. I think that's the, because you can either take big bets for a small uh, big bets for a small move, or you can take small bets for a large move. And I favor the second one,
small bets for a large move.
for a larger move. Yeah.
Hmm. And you mentioned diversification there. So, do you mean diversification across markets or across time frames, or
Systems.
both? Or systems? Yeah.
Systems. Well, actually, yeah. So diversification actually have three aspects to it. The first one is, as you mentioned, markets. You can diversify across markets. The second one is diversify across time frames, and then systems or methodologies, or even better, return drivers. I think that's the best way to put it. Um, I try to have across across three ways, and I do that by having what's called a core, a satellite approach. So the portfolio has a core aspect to it. I mean, where the largest part of the cash is invested. I think that's probably around 80% currently. And then I have a satellite, which is short-term trading. So it's the core part of the portfolio is investing with ETFs, and that's broken into which we can elaborate a bit more about it a bit later on. And the
Mhm.
satellite is futures trading. So so that's one way to diversify across time frames. So you've got the core part, which you may be holding for weeks or months. For example, through trend following with ETFs, you can see the weekly chart on that, and then you can diversify with time frames across having positions which are your holding period is less, so 3 to 5 days. So that's one way. So this is one way to diversify across time frames, having positions for weeks and also having positions for a few days. I don't do intraday trading. So in theory, the principle can be done, with even more time frames, but I just choose not to do it. Again, but what I just make sure that what I say is a way, not the way. So I'm not presenting a template for everyone. I'm just presenting a template, my own template, but it won't be for everyone. So that's the first way to diversify across time frames. So have a core portfolio, core part portfolio, which is a bit long term, and the um, some parts of it will be for futures trading. And the reason I do it, because futures trading is requires only margin, so you have a lot of leftover in terms of cash. You don't actually need a lot of it, so you can allocate that for more long-term positions. So that's the way, first way. So you can also diversify across markets, which is, you can have your portfolio hold various ETFs. So the core part is broken in half. Half of it is on equity index ETFs, because these the equity markets are have an upward bias on a long-term basis. So these are good for holding positions for a long time. The other half is for trend following with ETFs, again, for other asset classes. And futures is across asset classes. So that's how I have the diversification across markets. And the third part, how to diversify across return drivers, is by creating strategies for my short-term trading, which is the core of its strategy has a different setup, if you will, a different reason to belong. For example, it may be commitment of traders report, it may be seasonal, it may be momentum, it may be sentiment, or a combination of both. But each one has a different, again, return driver, a different reason why they should belong. So, for example, for the next few days, soybeans have a very good um, positive seasonality, something that I'm looking for, but its technical picture is not that good. So then you go how to combine the technicals and the macro. So like do a ranking of the trend versus the macro. But here's a return driver for you. Or you can also look at markets that have a commitment of trader report, bullish or bearish bias, and so on and so forth. So these are a bit uncorrelated, the strategy, or you can have a pure something that's purely momentum. So that's the at the high level how you can approach the diversification across time frames, markets, and systems.
Yeah, very good. And we did skip on a little bit, and there's loads of things there I want to get to, and they're my later questions. But I just want to go back uh, into your journey a little bit when you were learning technical analysis, leaving university. I read that you had some early success in a bull market. Is that right?
Oh yeah, yes, because right, okay. So I went to uni in 1993, finished at 96, then do my military service for 2 years. So that was 98. Now if you check any chart at 1998, you'll see that was a bull market, an equity bull market. So it was the period of my life when I thought, man, I'm really smart. This is really easy.
Mm,
But it was literally the definition of confusing brains with a bull market. Any kind of mistake can be forgiven when there is a very strong upward bias. So yeah, I was both lucky and more unlucky
mm.
to have a bull market as my first experience, because it makes the whole trip or the whole experience much easier than it really is.
And what did you start doing? Like, what was your approach in the bull market? Was it just get long, or did you have a strategy? Or
Well, any kind of strategy worked
no?
because it was a very strong bull market. Yes,
Yeah.
well, anything you bought basically was profitable in a very short time. The market was
Mm,
very forgiving. It was, it was difficult to lose money in that kind of environment.
yeah.
Um, so the I didn't have much of a strategy to begin with. I mean, I did some basic risk management, some basic trend identification, but it was everything was very basic. I was still learning. I haven't So I had to really start doing my own research or find people that would really teach me. And
Mhm.
so everything I did in the beginning was very simple.
Yeah. And I guess when the inevitable bear market came, how did you try and adapt, or how did you face it? I guess you lost initially, but did you then have to come up with new strategies, or how did you progress through it?
Right. Well, after my first losses, I realized that if I was to stay in this game, and I really wanted it, I had to start learning, but learning not from an academic point of view, but from a practical point of view. And this is where technical analysis helped me a lot. Again, so I went through the whole journey of testing indicators, experimenting, learning, but my desire was to devour everything as much as I could, as fast as I could. So that was
Mhm.
my motivation. So I went through a lot of techniques. Um, so I lost a lot of money, but I didn't lose my courage.
Mm.
And one good thing that I had was I kind of had an instinct, if you will. I don't know how can I attribute this on distinguishing things that don't work with things that work pretty early on. So I stayed away from techniques like Elliott wave, or using things that a bit like trend lines, and or anything that support the resistance. So anything that was a bit too subjective and try to quantify things.
Mm.
Um, and I'm not saying that these things cannot work, but usually they don't, because I have not seen these techniques work with the exception of one or two people. And over the course of my career, I have always been very careful to say, this thing doesn't work with, uh, and rephrase it as I cannot make it work. Because,
Mm.
for
Okay.
example, Elliott wave is something that I always believed it doesn't work. I mean, it's too many counts, too many alternative waves, to this, to that. Up until I met Tom DeMark and saw his work, and he made it very mechanical. And I saw, wow, you go, it can work. So he
Mm.
also found a mechanical way to work trend lines. So basically, things that everyone was using at a level which was a bit too discretionary, he made it very mechanical, very rules based. So that was my philosophy at that time, and I tried to experiment with many ideas from a technical point of view, but I've always had something missing. Because technical analysis was always answering the question when, but I did not have the question why. So I've always tried to had that why. I mean, why does this happen? We saw a breakout. Okay, so but why did this happen? And I'm not talking from a news point of view. I needed to know it from a data-driven point of view, something that I could always go back in history and say, oh, this happened, so that was the result.
Mm.
And fundamentals gave me the answer to that. So I've always tried to combine technicals and fundamentals.
Mm. When you say not from a news point of view, from a data point of view, as in, say, we have a news headline about uh, uh, that European Ukraine to Russia oil pipeline getting shut down, right? Which is kind of decrease oil supply, push up the price, and then we saw oil start to break out, or oil futures start to break out over the last couple of days, not even a couple of weeks.
Mhm.
When you say data versus the news, what is the data in that? I mean, because in my head that was the reason, and it was based on a news headline. But there may be multiple reasons. But when you say data, how do you find the data point that's the driver?
Right. As far as I'm concerned, at least there are four categories of macro data that I watch. The first one is uh, the business cycle.
Mm.
I think it's extremely important. Now, the business cycle can be broken up in two time frames. First of all, it's the monthly, when, of course, you can look at things like economic statistics. And then the weekly, which I usually do my intermarket analysis, how the relationships and the correlations between other asset classes influences. Because um, I, I believe that watching one market in isolation, you're missing a lot of pieces to the puzzle. So it's a very interconnected financial world, and what happens in bonds and rates influences FX and also influences stock prices, and what happens in FX influences flows in bonds, commodities, and so on and so forth. So that's the first data-driven approach, watching the intermarkets. So the second piece of data of macro, if you will, is commitment of traders report. Again, that is published on a weekly basis. It's a hugely important piece of information. Basically, it shows you the open interest of three types of traders, which is commercial traders. Commercial traders are the ones that participate in futures markets because they have for their business purposes. For example, you mentioned oil. BP will be a commercial trader, will be a producer. Or you might have someone like an airline company, British Airways. Again, they will be participating, but as a user. So you've got users and producers of commodities. Or Kellogg's, they will be participating in corn futures in order to produce the cornflakes, or sugar markets, and so on and so forth. So that is big information, commercial traders. So the second category is funds, trend following funds. And then you've got the leftovers, which is usually, but not exclusively, retail traders, because in some categories you may have commercials also going into retail categories, although I don't gonna be, that's a bit of a detail. So by seeing what these types of groups of traders are doing collectively, because the CFTC, which publishes this data, will not say what each company is doing, but they will show you as a category, so what commercial traders are doing. And you can find a lot of interesting patterns there. So usually commercial traders by and large are usually against the trend following, as the name says, they follow the trends, they buy on the way up and short on the way down. You can also see extremes in in retail traders. So that's a very important piece of information. The third part is seasonals, because they happen based on repeating business patterns. It is, a fundamental piece of information. When big companies usually do the buying or the selling or the hedging, or there is increased demand for a product on a seasonal basis. For example, for energy markets, there is usually increased demand during the summer, not from a consumption point of view, but from a storage point of view. Some commodities are more demand related. The demand driven are more supply driven. So, for example, orange juice is more supply driven. Something happens, bad weather, there's less production, because people's, you can only drink that much orange juice. For example, commodity, this is more, again, this is more demand driven, related to the economy, and so on and so forth. And the last part is sentiment. And I think it's a really big piece of information. It's kind of underestimated, but it's very important, because sentiment is reversely correlated to liquidity. Because the more bullish someone is, the more they tend to get invested, and tops they're fully invested. So a sentiment indicator shows you, it's like a reverse engineering how much cash there is available in the system, broadly speaking. So these are the to answer the question, sum up, this is my data driven approach to see what the macros are, rather than from a news point of view.
Yeah. On the seasonality, so do you, I guess, just map the returns over time of each futures market and then kind of extrapolate what
Good. Yeah. There are many ways to do it. Each one has its pros and cons. So it's kind of like creating futures contracts. I mean, you've got continuous futures contracts. There are many ways to stitch them up, to put it this way, and each one has its pros and cons. Same thing with seasonality, but there are a lot of quirks into the data. I mean, how you deal with the data, plus with the time frames, because you can calculate seasonals. For example, for a 5-year period, a 10-year period, 15-year period, all the data. You can have seasonals for bull markets or bear market seasonals. So there are a lot
Mhm.
of ways how you can calculate it, and each one has its pros and cons, and you have to tailor it to what you're trying to do.
Mm.
Or you may have to exclude data. For example, there may be a period when you had a huge bear market that skews the data. Because if you go for example, you calculate based on the returns, that period will skew your data completely and may show an excessively bearish period when it was one off.
Mm.
So for the past 15 years, you may have one bearish period, but it was so strong that it might skew the rest of your data. So again, there are a lot of um, things you have to be a bit careful with seasonality.
Mhm.
Plus, it's not a standalone tool. You always have to be confirmed with price. So when I use it as a setup, again, just make me do a small parenthesis here. My trades are always on 4 parts: a setup called the 4S framework: setup, signal, stop, and size. So seasonals is the setup. It's not a signal. So which means I may have a bullish seasonal period, for example, as I mentioned, soybeans, but I have to confirm it with price itself. And that's
Mm.
how you can rank. It's better, if you will, to have a bullish seasonal within an uptrend rather than a bullish seasonal in a downtrend, if that makes sense.
Yeah, I love that approach. Maybe it's my macro bias that is drawing me towards it, but I love how it's data driven because of how abstract macro can be and how many people on the side of macro, especially FX macro, for example, have very lots of different opinions about what should and shouldn't happen. Um, and that key of tying it in with price, because I got lost personally in the macro for a long time, thinking that things should be this way, and they weren't, and ultimately it was just price was is the way it's going, So whether it should or shouldn't be going a certain way, if price is going the other way, um, you have to go with price, right? We're not trading macro
Absolutely.
releases. Yeah.
Absolutely. No, price pays, as a friend of mine says. And at the end of the day, we all trade price, but there is a lot of noise. That's the problem. There is a lot of noise in prices. So
Mm.
through various techniques, either technical or fundamental, primarily fundamental, you're trying to filter out a bit of the noise and try to see when there is a real move coming up, because
Yeah.
markets move from A to B for a reason. It doesn't happen. The trends evolve for a reason. So that's what we are trying to find, the reason behind it. Um is there legs to this move, or is it a whipsaw, going back and forth?
Yeah. And going back to when you mentioned sentiment, how do you measure? I am assuming you mean consumer sentiment.
There are, well, sentiment indicators. They come in many sizes and shapes, and a lot of data can be classified as sentiment. Others may or may not agree with this. So basically, sentiment, you can divided into broad categories: what people say and what people do. So it may be, for example, surveys of how people are feeling bullish or bearish, or you can reverse engineer it to their positions. Another way to you can but it's a big bucket, so there you can also throw things like breadth. So I may not say it's sentiment, but yeah, I think in my opinion it is. In any case,
Mhm.
without you know arguing about semantics, if we because I put breadth there as well. Someone may not agree, but that's also a source of sentiment. So, for example, seeing that's also, you can use that for FX as well. You can create custom indicators for breadth, for percentage of, or for equities. You can see the percentage of stocks above say 200-day moving average. So when you see an index going up, you can try to understand, does this move have any strength behind it? Are there other companies participating in this rally, or is it just a few stocks leading the way? Or, for example, you can see if there is too much participation. For example, if you get like say 80-85% of the stocks above a 50-day moving average or 200-day moving average, that's probably a market that's getting a bit frothy. You can also have breadth thrusts. There are a lot of patterns. You can see advanced decline lines, McClellan oscillator, and so on and so forth. I mean, there are a lot of indicators and data you can use for sentiment.
Okay. Yeah, very good. Um, you've just reminded me when you mentioned about how markets are interconnected. And I think it was probably when I saw that yen uh, kind of debacle back in middle of this year when the yen started to rally and equity markets sold off. When I started to realize that kind of interconnectedness. But I think it's something that really, I don't know, I just really liked it. I think it's, for fear of sounding like a nerd, I think it's really cool the way it's a big kind of ecosystem,
It
right?
is. It
It's
is. I
like,
mean, intermarket analysis has come a long way. I mean, it started by the study of it, at least the popularization of the study of it, from John Murphy and Martin Prink. And I had the pleasure of meeting Martin as well, who's a true gentleman, not just a technician's technician. And they've done the definitive work. Then the late Mario Ruggieri also did a lot of good work. There are a lot of people who've done. Um, it's not a hugely popular subject, but I think that was my first answer into fundamentals, into macro intermarket analysis, because it was very data driven. Again, you can see the correlations, and each asset class is responds to a different part of the economy. So you've got rates, you've got um, the stock market, showing how the corporate world is doing. And if you want to dissect it even more to various sectors, you can see, what again, you have utilities, you can see financials. Some sectors are more interest rate sensitive, like utilities and financials. You can have others which are more related, for example, to consumer demand. Others may be more to energy. Again, so if you want to get really granular about it down to the sector level, then you can see which sectors are more which they respond to different environments. And you can also see the commodities, which is, again, it's like a very broad scope. For example, we've got um, precious metals, the energies, um, you've got industrial metals, which is completely different game. You've got agriculturals. So by and large, the way I have segregated, you've got 10 different sectors in the economy. So you've got rates, equities, and the various sectors of the commodities, and that you can also dissect it, and you can create a lot of intermarket relationships between this. There's a lot of um, hidden information and messages there in these types of relationships. Sometimes they may be conflicting, because
mm,
the good thing about watching a lot of types of indicators and types of data is you can see the same thing from different angles. The problem with it is that the more angles you add to it, the more the messages may be becoming a bit mixed. One thing may be bullish, one may be bearish. So this is where experience comes in, and you follow a weight of the evidence approach, when it's never like really black and white. So you go look at 10 things, and 6 or 7 are bullish, 3 are bearish, and 1 is neutral. So you say, okay, I'll go with the weight of the evidence. But to my knowledge, it's never been like everything points at the same direction. Almost never.
yeah, yeah. I think from my experience, which is definitely not as data driven, it's not a perfect science, but it's the kind of thing that, as you said, there can be secret messages, right? When you see the 2 year yield, ripping after a 25 bit cut, plus you have gold up, commodities up, and Bitcoin up on the first trading day of the year, kind of smells like inflation reacceleration, right? Or the market kind of moving towards hedges for things like that may be an indication that that could be on the horizon, or the market's trying to price that. Or it was one of the reasons I was longer oil, or that I took a bias on oil, and not because of the oil market itself, just because of the rallying towards that kind of narrative. But I suspect I need a lot more data behind my approach, having talked to you, right? And it's my last question on macro, I promise, but it's very selfishly like my favorite topic, right? So I want to talk about the COT data briefly, because it's quite, I think Jason Shapiro has really made this a really well-known thing now. Lots of people now look at this. So I guess if you had one thing you look at in the COT when you're building out strategies, how do you approach it?
Um, it took me a lot of time to, well, it first of all, it's if someone just plots the data, you'll see that there is a big correlation between what commercials and funds are doing with price. I mean, you can start seeing the relationships there, and that there is some kind of a method to the madness. The problem is that it's an awful timing tool. So if you try to time the markets from, so you can see commercials are buying a market, and it's falling. So you say, okay, eventually it will be bullish, but when? So of course that's the technical part of it. But in recent years, I created a system that kind of like has kind of a timing value from the commitment of traders report. So to answer your question, I do look at primarily the commercial positions, uh, with some twists to give it kind of, so created a system that has semi timing value to make it a bit more accurate. Also look at the retail traders, but look at from a sentiment point of view at the extremes, because
Mm,
retail traders can be correct sometimes during the move, but they are incorrect at the extreme. So when a market is, for example, rip roaring bullish, retail traders or small traders will be buying. So they go with the market. So they're wrong at the extremes. They will be too bullish at the top of the market or too bearish at the. So you can't just mechanically say, okay, they're buying, I'll be selling. It won't work. You
mm,
can also look at the dissect the data a bit more, look at the commitment of traders report as a percentage, say, for example, of open interest, and start looking at the numbers that makes the market tick. For example, when the commercials have a large percent of open interest, or they have a very a lower percentage of open interest, and other ways as well you can manipulate the data. Of course, these are talking about the legacy data. There are other types of data you can look at. So I created models around this, so which give me signals, if you will. I hate the word signals because it's usually associated with like a buy or sell, but I'll call it, for lack of a better word, I'll call it signals or an alert. So what it does, it creates a buy or sell signal or alert on the weekly chart, and then turn on to the daily chart to take a position, but independently. So for example, if I get a signal, it's Friday, market is bullish or bearish, as of Monday, then I will start looking for a signal using completely different indicators. So I use it as a setup tool, not as a timing tool, although I do have managed to give it a bit of a timing value as well. But the signal will always come from price, not from the background information. It will never come from commitment of trader report. It will never come from intermarkets, never from set. These are my setups. The first step, the setups, not the signal.
mm. Thank you for sharing that and those ideas about the COT, because I do hear people talk about it, but I don't hear many guidelines on how to approach it. So that's really useful for me as well, because I will just listen to what you say and go and download the data, right? So thank you, and it's a perfect segue into the actual technical triggers, right? So when you say you'll never use that type of data for a buy signal directly. I'm right in saying you use technicals on the daily for your triggers. Is that right?
Absolutely. Well, yeah. So when I go into the daily chart, I have what I call the core four of technical analysis, the four most important aspects of price, which is trend, momentum, volatility, and relative strength. So trend basically gives me the direction. I have an 8-stage model. So again, everything is rules based. So when I look at the market, is it bullish or bearish? And each um, section, like whether it's bullish or bearish, its direction is sub-segregated in 4 parts. And it's very easy, and I'll explain. I mean, because actually I'm creating a trading course for a part of the trader development program, which I'll be giving for free because I really don't want to be charging for courses. What basically, this is a bit of a
Huh?
unrelated, but the thing is, what I want to be doing is I want to create a course which will be for free, and so the information will be for free, but I will be charging for implementation. So I'll give the course for free and say, people, if you want to look at it, see that you're on time, but if you want to put it to practice, come and see me. So it will be free.
Yeah.
So
Yeah. Super.
I'm saying this because I will explain fully, what the model does. So you've got bullish and bearish trends, long-term bullish, but the trend is always you have multiple time frames. So sort of, I usually explain it through an analogy of like a watch. You've got the hours, the minutes, and the seconds. So you've got long-term, medium-term, and short-term trends. If you look at the possible combinations of long, short, medium trend, you have basically 8 possible combinations. So you've got long-term trend up, medium trend up, short-term trend up. You can have long-term trend up, medium trend up, short-term trend down. So if someone exhausts all the possible combinations, these are 8. So you can create like a sine wave, an 8 framework model. So based on that, I can classify markets and say which markets are in stage 1, which markets are in stage 2, which markets are in stage 3. So that's the trend. That's my trend model. The second model I have is look at momentum, because trend is direction. Momentum is speed. So you may have two cars going from, say, London to Birmingham. That's bullish. One may be going to Southampton, bearish. So, but it won't give you the speed that they're going. One may be going 70 miles and one may be going 50 miles. So that's momentum. So with that, I created the MACDV indicator. Actually created that in 2015, published a paper in 2022, got a couple of awards for it. So this is the indicator I use for momentum because it's an unbounded indicator. So it's not like the RSI or the stochastics when they go from 0 to 100, then that's it. Then the market can be expanding, but the indicator gets pegged at these levels. So the MACDV, being an unbound indicator, what it does is adapts to the market, so I can truly measure the speed. So that's the second thing I do. So I see, okay, the market is bullish, stage 2 or stage 3, and how much speeds does it have? There are, again, 7 different ranges. So we've got 8 stages, 7 ranges, and as you can see, these are very systematic and that is very rules based. So you can take, say, the market is in this stage and that range. I've got a buy signal. How does that perform? So all of a sudden, you can start being very rules based. And even if you don't want to be fully systematic, at least you can have a basic backtest and see what are the chances of, say, the setup as the market is right now. The third thing I look at is volatility. And then again, I created an indicator called volatility valuation index. It was inspired by my friend John Bollinger, which once told me that low volatility is where trends are born. High volatility is where they go to die. So I've always kept that quote, and I've kind of wondered how can I define high volatility and how can I define low volatility. So I created an indicator, the volatility valuation index. Again, it's unbound indicator, which shows you when you have too much volatility and or you have too low volatility. And that's a great setup. And the fourth aspect of price I look at is relative strength, which basically compares the asset classes between them, which is relatively stronger. So, for example, you may have two markets that are the same stage, same trend, same momentum, same speed, but have different distance. So, for again, going back to the analogy, one market is going from two cars drive from London to Birmingham, but some will be in between, and some may have started. So both bullish, both going 70 miles, but has different distance. So if you look at your car's dashboard, the speedometer is momentum, the odometer is relative strength. So these are the core factors I look at from price.
Very good. I think I was just thinking when you were talking that I might title this video "The Only Video You Need to Watch on Technical Analysis." I don't know if that would make you uncomfortable or not, but I might do it because I think that is such a super outline of what's actually important. And to just invert the question a small bit, and again, it may be a little bit of controversial, and you can say these didn't work for me. But if I had to ask you what you would avoid or what doesn't work for you in technical analysis, what would you say?
Uh, what doesn't work in technical analysis? To tell you the truth, I mean, for a long time, I didn't think trend lines worked. I mean, it, they do work, but I just couldn't get them to work because you can get like 50 people to draw 50 trend lines, and they would all draw it in a 50 different ways. And that's what I didn't like about trend lines up until I learned from the mark how to actually draw trend lines. So you made that, so that can also be made to work. um I see a lot of stuff on YouTube from various techniques nowadays, which are very popular. Sort of what's called smart market concepts and all this sort of stuff, which is basically older techniques, sort of like Wyckoff, which have been rebranded. So
Hmm.
basically, anything that is too subjective, I would try to stay away from. Anything that you can measure, you can quantify, it's something that can be incorporated into my repertoire. So, for example, candlesticks. It's a bit, controversial, but the problem is sometimes it's mostly how people use them. It's not the candlesticks themselves, because candlesticks, for example, patterns can be used for a signal, not for a setup. So what I want is, for example, good seasonals, good COT data, go into my technicals, have good trend, good momentum, and then look for a signal. But I wouldn't take a bullish candlestick pattern out of context. So I think that's the misuse of these techniques that the problem is. So a lot of people blame the tools for bad craftsmanship. So they say,
Hmm.
okay, this pattern, this happens, so the market has to fall. Well, no, it doesn't. I mean, it's a short signal. If the market has a tendency, I mean, there are a lot of fundamentals that drive towards that direction. Um, I don't use volume a lot to answer your question. Again, that doesn't mean that it doesn't work. There are people who have done it. There is a gentleman by the name of Buff Dormeyer who recently wrote a book. He's also a fellow who also won the CMT Association, the Charles Dow Award, and he's done a lot of work on volume, but I haven't. So that's something that hasn't worked for me, but that doesn't mean it doesn't work in general. I also don't use
Yeah.
Fibonacci. Again, very subjective in terms of like how you can draw where the points to draw the support and the resistance levels. But people like Tom DeMarco or others have used it, or Larry Pesavento have used it. Again, I'm very careful to say it doesn't work with I haven't made it to work, because a lot of things that I consider didn't work, I've seen them work.
Yeah. Super. Thank you for that. I also had the same feeling about Fibonacci because my mentor uses it, and I could never fully tell if it was his 40 years of FX spot trading that was really driving the feeling that this could be a level, or if it was the actual Fibonacci itself. It was never on its own. It was always paired with 40 years of knowledge. Is not he has that, but if I use it, I don't know if it's I don't believe in it and then therefore it doesn't work or something like that. But I also had that
And that's why
challenge.
I always think it's very important to be rules based. I mean, in technical analysis, although a lot of people don't use it in this way, but it's very rules friendly approach. You can create frameworks, blueprints, if you will, rules based, and then you can start testing, or at the very least, even if you don't want to test it, although I would suggest people start testing to give you a rules based framework. So, for example, going back to the my 8-stage trend framework. So you've got four stages to the for bulls, 4 stages for bears. If I color code this and say, for example, when the market is short, mid, intermediate, and long-term trend down, and you color code this as red, you make it very visual. Say, okay, when I'm in the red, I will not be taking buy signals. I will only be taking buy signals when I'm in an uptrend. So even using this very simple level, it can be very, very effective to be rules based rather than seeing just a chart and say, oh yes, so it looks kind of bullish, and this is a head, a shoulders pattern. That going back again, this is another technique I thought it would when I first started. Um, a lot of people used Edwards and McGee, the or Bulkowski's patterns. I never thought I would use these, and I thought, man, this really doesn't work. It's too subjective for me because one would draw head and shoulders patterns, but then again, they can be quantified. There was a gentleman by the name of Art Merrill who a few decades ago created the a set of 4-point patterns, M&W patterns, and quantified this. Again, it
Mm.
can be worked. Linda Rasky has done some work on it. There are others as well before her. So it can be as long as things can be quantified, tested, and classified, you can create rules about it. And that again, that goes back to the question we had at the beginning of the interview about discipline, because once you have a rules based set, so for example, when the trend is in stage 5 and it's like so it states it's falling a lot, short, long, medium term round, I will not taking any buy signals. I will be looking for sell signals. So then you go into your momentum. So you go a checklist, if you will, like a pilot. So you go a checklist and then you tick things off, and that brings a sense of security, or you know what you're doing, and that breeds discipline. Plus, do it again. Plus, have a small position size, and that uh, helps you deal with the emotional aspects of trading.
Mm. Yeah, I'm learning so much talking to you, and one thing that stuck out is the order you do things in, and I hope that's a big
Let,
takeaway for people, as you said, that
uh,
all of these things can work depending on
I have
where they're used. And
let me. I've got a graphic here. I don't know if it would have just opened it.
yes.
Perfect. So right at the bottom, I've got macro. So sort of like a roadmap, a learning path. So this is the visual, the visual I use. So I've got intermarkets, then I've got the COT score, sentiment, and seasonals. So all
Mm,
this is part of the multiple time frame, multiple factor decision support system. So I've got here weekly or monthly, because intermarkets and fundamentals can be done both on weekly and monthly. I've got the commitment of traders report, sentiment, and seasonal. So this is my why. So then I go into the technicals again, step by step, the trend, relative ranker, MACD, volatility. These are the technicals. So once I've got
mhm,
my understanding, the checklist, if you will, the step-by-step roadmap for combining fundamentals and technicals, then I go into the strategy, the setup score, because I score markets based on, well, if you look at it, you got bullish or bearish fundamentals, bullish or bearish technicals, and the combinations between this, because you
mhm,
may have a bullish a bullish fundamental setup. It's completely different if it's in a market is already bullish. That's really rare, but that's really powerful. or if you're going counter trend. So then you've got the signal, the stops, and the size. So this is my step-by-step framework, if you will, on how to create to analyze markets.
Yeah. Super. And on that volatility component in the technicals, so is that I mean, I'm not fully sure how you've built the indicator, but if we just take the Bollinger Band, for example, are you looking for where we have kind of a small Bollinger Band range? Are those opportunities where it's low volatility? You said that the trend could take off, or are you just trying to avoid
Yeah,
high
that's
volatility?
a good question. Well, you can see it's kind of the equivalent of that, but I think it's the well, in principle, it works kind of like that. But well, you're looking for contractions in volatility and expansions. So perhaps let me, I don't know, maybe we can find a chart here. So for example, a few
Sure. Yeah.
days ago, I was looking at the S&P 500, but the volatility valuation index got at a very high level. So that showed me that the decline might stop a bit. So let me, well, pick a market so I can look at the chart. What's your favorite market? Which one would you look at?
Dollar yen,
Dollar, yen, okay.
or just yen futures, if you like.
Sure. Um,
I avoid. I feel like I had put together a kind of trade plan on a short USD play, which didn't work that well after non-farm payrolls. So I'm kind of a little bit detoxing from short USD at the moment.
all right, so I've got everything here. Seasonals, the MACD, I've got the everything. So let me unplot everything before I share my chart, and we can perhaps look at a few examples. All
Cool.
right, so indicators, personal goal volatility valuation index. Right, okay. So let me go back to sharing my screen, share screen. I feel like I'm doing a webinar.
Yeah, well, I didn't know it was going to again turn into this, which is great though.
Me
It's
neither,
something
but
different.
I think it's because technical analysis is so visual. I thought it's better to. Can you see my trading view?
Yeah.
All right, so let's take these indicators because I have a thing about having clean charts. Right, so
Hmm.
right at the bottom, I've got the volatility valuation index. So when it gets high, that's when, as our friend John Bollinger said, trends die, and low volatility is when they get where they go to where they're born. So as you can see,
Hmm.
whenever the volatility valuation is index, it's at the market is either at a high or a low. Uh, High volatility is trend agnostic. Okay, so you can have, for example, high volatility with a top or high volatility with a bottom. So when you have high volatility, you what you're seeing basically is the current trend is at a risk of reversing. By and large, usually high volatility most of the times is a downside phenomenon, but not exclusively. Just keep this in mind. So when I see high volatility, I don't associate this with necessarily with a top or a bottom. I see what the prevailing trend is. So for example, again, high volatility short-term top, high volatility short-term top, again, high volatility short-term top, again, high volatility short-term top, high volatility short-term bottom. We can go even back further in time. So it can be used as a very useful setup. Again, let me squeeze the chart a bit. Again, high volatility gave you a bit of a short-term bottom, not much. Another one gave you the bottom for a couple of months. The market had a counter trend move. Again, high volatility gives you a top. And it is a very useful tool. Again, not used in isolation, but used in conjunction with other things.
Yeah.
So what I do is look at the trend, then look at momentum and volatility and try to find patterns. For example, when I have extremely high volatility and extremely high momentum, so that puts me on an alert. Wait for the price to signal. I don't get from the indicators either momentum or volatility. These are my setups. Small position size, stops, and that's it. And I don't expect for my trades to all of them to win. I mean, if I get about, I know I'm wrong a lot. I'm psychologically prepared to be wrong a lot. I mean, even with all these confirmations, with all the tools, it's very difficult to go past 55, 60% winning trades. It's very, very difficult. But I'm okay with that because I'm looking for my winners to be larger than my losers. So I've got an edge.
Yeah. And do you, I guess, add to those positions when you put them on, or
No,
are you kind of
no,
someone
I
that?
never add to my positions. I never add to my positions.
Okay. Any particular reason for that?
Well, because once I have a position, then I have to. I don't for as far as futures trading is concerned, I don't hold them long enough to give me uh, um, an opportunity to add in. My futures trading is very short term. It's anything from 3 to 5 days.
Hmm.
So
Okay.
I don't have an opportunity to do that. But even so, when I'm in a position, I have an entry price and that's it. And I just look to exit. I don't stagger into positions.
Hmm. And your long-term trend following on ETFs, is that different? Do you kind of scale into those or
No,
period those
again, that's
positions? Or
it's a binary. I know that you had other guests. I'm talking about the Rob Carver who do it a more gradual way. But again, different courses for different horses. No, it's in or out. I don't gradually get in. I gradually. Maybe I should look into this technique because it sounds very interesting. And Rob, I know uses a moving average crossover system, which is basically, and I've created a more advanced version of like the MacDV is basically a moving average crossover system. So perhaps it's time for me to look at something new. But for the here and now, I don't use that. Perhaps in the future I will.
well, it's interesting because I have a mix of guests. When I had Tom Basso on, I don't think he added to positions either. He actually trimmed his winning positions when they became too significant in his portfolio. So he was one of the first people that I heard not kind of system trying to increase his winners. He did the opposite,
Yeah, because
which
he
I
wanted
found
to
pretty
keep the
interesting.
weights. It basically was from a risk management point of view because he didn't want to have a too big a position as far as his portfolio. Because once the move goes your way, the position gets increasingly bigger in your portfolio. So that increases your
Mm,
volatility.
yeah, yeah. And on say Tom, as a two-time award-winning technical analyst and probably notably one of the best technical analysts in the world, you are around people like Larry Williams and John Bollinger, Linda Raschke. Along your journey, uh, is there anything that sticks out that you've learned from some of those kind of legends of the world
A
of
lot,
trading and the world of technical
a
analysis?
lot,
Yeah.
a lot, a lot. Um, I've been very blessed because I had two experiences that really helped me. The first one was I can't remember the exact year. I think it was probably in the late 1990s. I joined a list, an email list, because I was seeking for information from. Actually, I was seeking for people to ask, and I joined a list which was called the Markets List, which has been in existence for I don't know how many decades. And John Bollinger is running that list, and through that list, I'm still part of it today. So I'm probably more than I don't know 25 years part of it. I get to exchange views, and that's how I start first learning about these people. And over the years, we developed good friendships. The second very important experience I had in my life that was back in 2009, the CMT Association. Then it was called MTA, the Market Technicians Association, which is the largest technical analysis association globally, was looking to create a chapter in the UK. So John suggested that I perhaps run this, and that was an experience that helped me a lot in many ways. First of all, it kind of like put me on the map of the industry. A lot of
Mm,
people got to know me and my work, and more importantly to me, I got to meet a lot of people because in order to prepare for the chapter meetings. I had to invite guests or people notified me that they will be coming. So I got to learn a lot of people from the industry. And that was a learning experience, formed a few very nice friendships. But it showed me that there are many ways to skin the cat. So it made me more open minded. And that's when I
Mm.
started realizing that what the difference between I can't make it work and it doesn't work, because a lot of the things that I couldn't make work, I saw it working. And yeah, I made a lot of friendships. I mean, from John I got the basically a lot of things on volatility. And he's very knowledgeable. And one of the things I would say, and so Bollinger Band has been both good and bad for him. Good because it made him like a household name in everyone that has opened up a technical analysis chart. But say probably a bad thing is that people have associated him with the bands, but his knowledge is a lot more than that. So people may think, oh, John Bollinger is just the bands. No, he's a lot more than that. But maybe the rest of his work has not been that well promoted or made public. Larry Williams, who's a great friend, he's probably the person that has influenced my work more than anyone else. More than
Oh,
anyone else. I owe him a lot. Good friend. Uh, Tom DeMark, amazing person, amazing technician. Probably, I think him and Larry are the greatest technicians ever. Linda Rasky as well, Martin Brink, who's also influenced my work as far as intermarket analysis is concerned. So if you go back to the roadmap I have for um, my trading framework, each component, each section has been influenced by a different person. So basically, I
mm,
studied their techniques, put it all in a box, shook it up, and say, okay, let's see what comes out. And I try to adapt this to my own style, and which is very analytical, very rules based. So yeah, I learned a lot, and I owe them a lot.
mm. Yeah, it's kind of standing on the shoulders of giants.
Absolutely.
But I think that's such a great last point you made, that you put it together for yourself, and that you made it something that works for you. And another great point, that there's so many ways to skin a cat, right? There's how many people, uh, well, I mean, statistically are not that many successful traders, but there are lots of them out there, and they all have different weird and wonderful ways of creating an
Yep,
edge.
absolutely. So it's so, and that's why I believe it's having say someone says, "Oh, I have a system that works," is not enough. That's um, half of the information you want. The other half is to see if it works for you, for your own personality, and that's actually one of the steps that you have to do regarding the self-awareness. So what kind of because when you say trade, but that's like say I want to be a doctor. Okay, what kind of a doctor? Do you want to be a GP? Do you want to be a surgeon? Do you want to have someone that specializes in cancer? What sort of doctor? Same thing with the traders. I mean, you can differentiate across time frames. You can say perhaps trade flow. You can be fully systematic. So at the very least, if you build like a cross, you've got four matrices, how analytical you want to be, and what's your framework. And you can see that there are so how systematic you want to be, what's your time frames. So you can see that there are successful people all around these four quadrants. So you've got long term and non-systematic at the upper contract, like you've got your like Warren Buffett's. I mean, I'm talking about the most popular name out there. So you can be very short term and very systematic, like think Jim Simons, and anything in between. So I think the and all of them worked, and you might hear even conflicting in advice from each one, but it's not conflicting. It is that it's correct in its own context. So I think the most important thing is to find where you belong, um, and what are your skills, and try to leverage this. For example, my skill was I'm very analytical, so that's why I have to be data driven. So I'm not a very good. I'm a very analytical, which is good. I like uh, synthesizing disparate information. That I'm good. What I'm not good at is when I have to react very quickly. So I know I wouldn't be good scalper, wouldn't be a good market maker, but I'm fine with that. I'll just leverage what I'm good at and stay away from what I'm not good at. So that's why I don't do intraday trading, which I mentioned previously. But it all comes to self-awareness, and there's no shame in saying I'm good at this and I'm not good at that, because you can't be good at everything.
Yeah, yeah. Me too on the intraday stuff, I would say.
Yeah, I mean,
Like trade.
I've seen people who were very good at intraday trading. For example, I used to work in a proprietary trading firm called Futex, and I was working there with a guy called Navinder Sarao. He was the flash crash guy, the one that was extradited to the US.
Oh
Yeah,
wow.
Nav and I work right next to each other. I mean, he was yeah, I mean, literally, we were not at that time when,
Wow.
because he left afterwards, but we were working for a number of years together. And I was an amazing scalper. I couldn't do that. I mean, he was doing about thousands of contracts on the E-mini per day. I mean, there was one day who's done like 7,000 E-mini contracts per day. I mean, it would take me years to do this kind of volume. Because but he was doing the opposite of what I do. He takes huge positions for a tick. I like taking small positions for a bigger move. But
Hmm.
that was his edge. That was what he was doing well. So you had two people, sitting in the same office, side by side, looking at the same data, but they were in completely different worlds.
Hmm. Wow. Yeah. Um, you mentioned your system as semi-systematic there. Uh, I haven't heard you speak about the kind of discretionary. I mean, and maybe it's my understanding of the word discretionary, but what is the discretionary part of your system?
Right. The As I mentioned, the system has four parts to it: the setup, the signal, the stop, and the size. The four S framework. Sometimes I refer it to
Yeah.
the setup is discretionary, rules based, but discretionary. And I'm saying this because the setup is the combination of the macro and the technicals. So
Yeah.
some parts will be bullish, some parts will be bearish. So it comes a bit of a judgment call to say, okay, this market I want to be bullish. It won't be like I'm confused between
Okay.
bullish or bearish. It will be a matter of saying bullish or out, bearish or out. If I have any kind of like ambivalence about what it is, I'll stay out. So that's kind of the rules based, again, discretionary part. The signal,
Yeah.
systematic. Once I have decided that I'm bullish on a market, I'll switch on and then I'll wait for my mechanism to get in. So the system is completely systematic. So the signal is completely systematic. The
Hmm.
stop is also systematic, but the size is also, again, discretionary, a function of how bullish or bearish I am. There is a relationship that I look at um, between the trend and the macro. Basically, the setups I've got I've got what I call trade grade. So I've got trade A is like the best, B second best, C third best, and B is like really worse. So
Hmm.
these are a function of combining technicals and fundamentals. So I've got bullish on technicals, bullish on fundamentals. That's my A trade. My B trade is when I'm bullish on technicals and so on fundamentals, because the trend is, prevails. It's like trumps everything else. And D trades
Hmm.
is when I'm bullish, but I'm very bearish on the technical. So if the market is really falling, then I've got everything coming up, but that's like the D trade. So in order to relate it to position sizing, what I do is the higher the rank, the bigger the position size. So as I mentioned sometime in the discussion, seasonals are very bullish for soybeans right now, but they've got a long, short, and medium term trend bearish. So that would be a D trade for me. So if I might want to be taking it because of the good seasonals or maybe other factors like good momentum, but the trend is down. So that's a D trade. If it was the flip side, would be an A trade. So from position point of view, it would be different. There I may be risking more on the D trade. I will be risking less. So I may choose to take the trade, but I will be risking considerably less. So again, this the two parts are discretionary, and the other ones are fully systematic.
Okay. Yeah. Thanks for clarifying that because, yeah, because different people approach discretion differently, right? I mean, but I could tell by how many rules you had. I was thinking, where is the discretion amongst all these rules? But
Yeah.
that makes
Well,
sense.
especially for the setup, because the thing is, you'll have a lot of indicators, a lot of relations. So, for example, we had a look at volatility. You may look at momentum, and they may start giving conflicting signals, and how you can like balance them out. That is a bit of a
Hmm.
judgment call.
You you can be honest here, but have you ever put full risk on a B trade?
Yes, I have. But uh, actually, I've put full risk on a day trade, and that's
Already.
yeah, man, and that's actually the how the rules have come to life because I made mistakes and I had to learn from them. So in
Hmm.
order to avoid doing these mistakes, they came from pain, they came from losses, they came from agony. So I had to adapt, so I had to learn. So that's what I want to be sharing. So it can be a trial and error, not trial and terror. So yeah,
Yeah.
I've done all the mistakes, having position sizing wrong or canceling my stops or going against the trend. I think the mistake I've done more often than anything else, and sometimes I don't know, sometimes I'm a bit contrarian when I shouldn't be. Um, is trying to buck the trend. I think that's the biggest mistake I can do, and I've done it probably. I think that was the biggest the mistake I do more often than anything else.
Back the trend, as in
As
go against the trend, is
Yeah,
it?
yeah, as in like the market is going up and I want to short it.
Hmm. Yeah.
Go against it.
Amen to that, because I always do. That was my biggest flaw too when I started, was everyone's long, I want to be short, or or something. It's
And
hard.
that's why I created these rules based on things I've done wrong to see, so I won't be repeating them. I get the urge, I still get the urge, but I'm
Yeah.
trying to fight it.
Yeah. And I wish it was easy to learn from things not being painful.
It is
But for me,
to tell you the
yeah,
truth, there is a way how one can learn without the pain, or actually relatively less pain, but people don't want to do it because they look down upon this method, and this method is trading on a simulator on a demo account. But people try to avoid it because you can't make on a demo account and it doesn't look good. But if you have a rule set on when to go live, and also you have someone to oversee this procedure, and you see that you treat trading as a reward, trading live as a reward for your good performance on the simulator, then you won't be risking at least capital. You'll be just risking your time. So I think that's the most that's the most overlooked steps. Actually, that's the fourth, because we talked about the smart system. So first is um, self awareness, and it's market analysis, market knowledge. A is a trading plan. R is repeat and review. So that's the demo phase, the repeat review, the sim stage, when you set certain performance criteria, and if you achieve this, then you go live with one contract, then you add another one, then you add another one, and so on and so forth. So there is a method
mhm.
for someone to decrease the pain, but usually it doesn't sound as sexy, if you will. Say, what are you doing? I'm trading on a demo account. And a lot of people say that the demo account is not real, and it's 80% of the experience with 0% of the risk. That's my reply to that. And you have other professions who also use demo accounts, for example, like pilots. They also learn on simulators. Soldiers, they
Mm.
obviously they don't shoot their gun in a battle. Um, they go on to practice. Surgeons, lawyers, everyone, a lot of people do it. So I don't see why we shouldn't be doing it. It's just that it's not as as glorified, but it's a very valuable tool along with your trading journal, and someone
Mm.
to tell you what you're doing wrong, because at the end of the day, page 58 of your book will not tell you what you're doing wrong. You need feedback.
Yeah. Yeah, 100%. And that was the big thing I got out of having a mentor was not drifting off track into something and then going down the wrong path for a long time. Just to have someone to keep you between the guardrails of where you should be. As you said, yeah, it's hard to find it in books, and sometimes I'm not convinced unless someone I believe, which is your mentor who's done it before you, is telling me. And if I because unfortunately I was tied to some beliefs I had, and that was kind of really pigeonholing my view. I would only, unless the right person said it, maybe I wouldn't believe it. Like my dad has given me loads of great answers, but he's my dad, so I didn't believe him, But then I heard it from the right source, someone that I believed that had gone and done it, and then I said, okay, I accept that, and then I found that useful through my mentor.
Absolutely, and also
Um,
also journaling. I think these are I mean, a trading plan, a trading journal, and a demo account. I think these are most invaluable tools for anyone. I haven't met any
mm,
serious trader that doesn't have a journal, doesn't study it. But it sounds like bookkeeping, and not not very sexy.
yeah,
But
yeah.
it's
So
extremely important. It's extremely important.
yeah, it's the unsexy stuff that I feel like gets you the long yards,
Yeah,
or makes
stops,
the big,
position
big
sizing,
difference.
journaling, sim accounts. I mean, these are the stuff that people, I mean, most people want to look at the signals and where to get in, where to get out, sell bottoms, buy tops, but it doesn't work that way. And have a 90% um, winning trades, it doesn't work that way. I mean, at least not for me. And believe me, it's not for lack of trying, but having asked other people's as well, I mean, your winning rate, I mean, of course it depends on your trading style. I mean, if you're doing trend following, you can get by with the 35-40% at best, 35% winning trades, because you hold out your position so long that you don't need that many. But anyone who does anything like short-term swing trading, and it's very difficult to go above 60%. Very, very difficult. I mean, I haven't met many people who do it consistently. I may do it myself, but it's because on a hot run, and then I go down to 50%. So by an average, like you get, you have to be psychologically prepared to be wrong a lot.
Hmm.
It's not a job for the insecure. If you need constant um, validation, it's not the best place to seek it.
Yeah. Well, it's definitely not for positive validation anyway. You might get negative, negative validation often, right? But
Oh yeah, yeah,
um,
and that's where
yeah.
small position sizing helps, because it lessens the both the highs and the lows, so the emotional volatility. So you don't feel like God if you win, or if you don't like a total loser if you lose. So there is like a more stable, lesser bandwidth of your emotional fluctuation, if you will.
Mm, yeah. As as a kind of last question, because I know we're just into a new year. I was wondering how someone like you, a veteran that's been around a long time, successful trader, how do you look at a new year in terms of your plan? Do you have a kind of 2025 trading plan, or have you got your systems and you wait for the market to give you opportunities and you just trade, or how do you approach a new year?
My problem is that uh, I'm too creative, in the sense that I looking at markets, and also like creating indicators, creating systems, creating techniques, and I'm trying to cut down on that. So that's my and focus more on what I have. And I think that's the most important. To try to cut down because I love research so much. I think that's the at heart I'm more of a researcher than a trader. I mean, trading for me just putting on the last part of what I mean. Literally speaking, I spend like 90% of my time doing research and just very small time doing the order routing. I mean, just putting placing the
Mm.
trade just takes me for like a few minutes. So I'm trying to cut down on perhaps that, and also since I'll be launching this platform, I'm hoping to pass on the few things I know about markets, and it will be a nice experiment for me. And I'm looking forward for 2025 to see how this goes. See, I can pass on the semi-systematic approach. I know it won't be for everyone, but I'm hoping to find a small group of people that they will like it. It's going to be a low-scale operation. It's not going to be like a membership, like 5,000 members. So that's
Mhm.
my main plan for 2025.
Super. Is that kind of, I don't know, is there an early invite list for that platform, or is it still in under construction?
It is under construction. I have an invitation. Well, basically, I'll be doing a low-key launch, like for a founding
Hmm.
members. Um, I want to be doing a lot of things differently than what I've seen people do, without trying to offend or discredit anyone. But basically, um, I don't want to be selling a course. I've seen that, and I think I'm not really happy with that.